Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, as well as options and futures trading. If you're new to the channel, welcome. Just to give a little background on the channel, what I've done, I've taken about a quarter of my net worth and I have put it into what I call a roughly $500,000 experiment in which I am constructing an all-weather high yield portfolio that will try to accomplish or seek to accomplish excuse me, paying all my bills, as well as maintaining and paying down my margin. So one or two things will probably happen here. It will either have some success and fulfill that goal, or it will fail. And if it does, then we'll try something new. So welcome. Hit like and subscribe if you like what we're doing here to support the channel. So what I want to talk about today, I want to talk about how I control for inflation across cash flow life. Okay, and that's the name of this portfolio here. So I think personally, 2026 is going to be a rough year. I think volatility will return. I even think inflation is going to return. But I don't think necessarily inflation is going to return to asset prices like it has been, right? I think equities have done a pretty good job. We know gold and silver have done a magnificent job hedging that inflation that we've seen in the past few years. But I think one of the worst case scenarios that comes to my mind is when asset prices fall or have a deflationary period and cost of living inflates or goes up. I think that's probably the worst combo you can have. But it's something I think we should be mindful of, right? We're coming off of 3 double-digit positive years in equities. Silver's gone up more than 100%. Gold's gone up over 100% the past few years. We're seeing commodities play catch up. Platinum and palladium are starting to come alive again, right? They're starting to perform well, as well as just some other commodities in general. Everything outside of oil, which I think oil could have a decent 2026. So with all that said, just kind of everything that's gone on, right? Just looking at history, looking at the debt levels that we currently have in the US. We've got the Federal Reserve coming out saying they're going to be purchasing $40 billion in treasuries per month, which doesn't always mean inflation in asset prices, right? So how do I control for that? I want to be mindful of, as my cost of living goes up, right? I need cash flow life to increase its distributions to me as well. So the number one thing that I am doing to control for inflation or the cost of living going up is that I'm dollar cost averaging back into my strategy. Okay, so I've got here 15 different positions, okay, that I buy into each and every market day. And what that does, dollar cost averaging actually serves a few, I think, key roles across the portfolio for high yield investing here. Number one, it kind of helps smooth volatility, right? So on down days like we're having today, we have the jobs report come out for October and November, revised. And so markets are selling off around that. So it just helps kind of smooth over that volatility. I would much prefer buying assets at lower prices than higher prices, right? I've always said that most people seem to love a good bargain. They love to see a sweater half off, but when their stocks or bonds are half off or what have you, right? That's usually when most people refuse to buy. So I like when asset prices fall. The lower asset prices go, the less risk there is, right? I think we are sitting currently at very lofty levels. And reinvesting at these levels via dollar cost averaging doesn't necessarily always set well with me. However, that's why I buy my long puts and have my hedges that we've discussed in past videos. So the dollar cost average smooths over volatility. That's one big thing, right? It keeps my target allocations on track as well as best it can. I rebalance quarterly. So excuse me, next rebalance will be coming in March. Okay, so I'll be rebalancing the portfolio here in March. Try to get back to those portfolio percent allocations that I prefer across this portfolio. And the last thing dollar cost averaging does, I really like the inflation hedge. I'm buying more income, right, every market day. So I am dollar cost averaging back into this strategy $1,000 per week, about $50,000 per year. And right now, this strategy, this portfolio is yielding anywhere from between 25 to 30% as of this past weekend. I update everything over the weekend when markets are closed. That way I can get a better snapshot of how everything sits. So it's yielding about 25 to 30%. That's not taking into account the puts I sell to generate income for the portfolio also. And I'm doing that on very stable companies, right? Someone asked me, hey, why are you doing it on, stable companies? They don't generate a lot of premium. And that's true, right? But I am getting currently about a 15 to 20% annualized cash flow off just selling puts on companies like Bristol Myers, like Coca-Cola, right? Like AT&T. So that cash flow helps pay down my margin, help keep it in check while, having the majority of my put options expire worthless, keep pocketing that premium. And then if I'm assigned anything, what that does is that puts the shares to me, increases my margin buffer, right? So it'll bring my margin buffer up since I'll only be at 25% maintenance instead of 100% maintenance, like options collateral puts you at. So, and then I'll just sell calls to generate more income. So that 15 to 20% I'm making roughly as of now on big stable utility companies, blue chip companies, consumer defensive, those companies will, that income from those puts will offset the 4.5% margin interest that I'm currently paying. So that's another great way to kind of help with inflation as well. If I can keep, making that spread. So putting in $1,000 per week, I'm buying about $250, we'll just call it $250 per week in annual income, right? That's about $1,000 per month in annual income. So that's a great way to offset inflation. I have a six-figure cache of I bonds, which, I don't necessarily believe the CPI number. I don't think many people do, right? I think we see prices rise much faster than what the government or the Fed tries to tell us prices are rising at. But at the end of the day, I kind of say, what are we really going to do about it, right? At the end of the day, we have to just kind of accept that. But the I bonds, what's nice about them, if I ever had to sell them, I could pay off my margin quickly. They're all, liquid at this point. So that's another way I help offset inflation. And I bonds also play a good role with deflation as well, right? Because whatever you've accumulated, if we go into a 0% negative interest rate environment, potentially a lot of the I bonds have fixed rates, which will never change. So even when that variable rate changes every 6 months, even if it will go to zero, you still have a good deflation hedge across your I bonds. So I like I bonds. I try to hold most of my cash there. I think it's a good place to put it. Again, they're not liquid for a year, and you're going to waive the first 3 months interest if you sell them before the 5-year mark. But other than that, I think they're a great hedge across anybody's investment portfolio. And that interest is also tax deferred, which is nice. So if you can use it for qualified education purposes, then that you can get a tax break potentially there too. So again, like every other video, not investment advice, not tax advice, not now, not ever. So please do your own due diligence and research before ever making any investment choices. So I think dollar cost average, I think it's a powerful tool, especially across what I'm doing here, is I am using that margin to go in and buy more of my strategy, right? Just every single day automatically. So when we get those down days, I'm just accumulating more shares, right? So that's always a nice thing about dollar cost averaging, lower your cost basis on down days. And then again, keeping those long dated puts in place, which is how I'm helping hedge the deflationary piece, right? I think gold, I think is more of a crisis hedge. Hasn't always correlated with inflation, perfectly 1-to-1, but I think there is some inflation hedge across gold, across silver, across other commodities, because again, as the dollar becomes weaker, commodities tend to, offset that loss in purchasing power for your money. So love to hear your thoughts. Hit like and subscribe if you like what we're doing. And hope you got something out of today. So thanks for your time. Have a great day.